In this week's update, markets get what they crave. Very hard not to be bullish medium term, and precious metals on the move. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Well, look, it was a pretty negative week for most of it until Friday night with the Fed and Powell's speech, and that pretty much changed everything, or I should say, put it back where everyone was expecting it to go eventually. So let's look at the US market and where it stands at the moment. It's really hard to see what will derail this rally, and I hate to get in that mindset because my mantra is to manage risk first, and if you do that well, then the profits just take care of themselves. So I tend to look at the downside, and I don't like to think about really rosy forecasts because it colours your thinking. But in this case, I'm really struggling to see what will derail this rally into the end of the year. The Fed clearly now is pivoting to supporting the labour market. The labour market numbers are coming through now dramatically slower than 2024. And also they want to promote growth as well. So cutting rates is certainly playing into that narrative. So this is a very significant change that Powell made on Friday night, and the markets responded. The only real risk that I see, apart from Donald Trump, of course, is that the markets just get too exuberant. Everybody starts to accept the narrative that I'm just giving you as the only narrative, put their blinkers on and just buy and keep buying. That's the risk. And to a degree, I think that will probably happen a bit because markets always get overexcited. They move ahead too quickly and then they have a bit of a pullback. But I think it's going to be 2 steps forward, 1 step back through to the end of the year, and that by the end of the year we'll see indices higher and we'll see the best of the best much higher. So it's a very exciting period ahead of us. And if you just look at the boxes that are ticked at a big picture level, we've just come through US earnings season. There's still a few stocks left to report, but the majority are in. And earnings growth for the S&P 500 is being calculated at 11.7% for Q2, and that is nearly triple what the market was expecting. So it's way above. There was an 82% beat rate, and we're also seeing quite prolific upward revisions from analysts because CEOs are speaking rather bullishly about their outlook. So all of that side of things seems to be taken care of. On top of that, we've got half a dozen seemingly unstoppable megatrends, from AI to defence spending to energy transition, etc., etc. You know what they are. And those tailwinds are not going to go away, even in the face of erratic tariff policy. They're going to continue on regardless. And then the final piece of the puzzle now is that we're going to get, or almost certainly going to get, monetary stimulus. And I can't see that Powell would have made the comments that he did on Friday night and then backtrack on them, because they really were a significant shift in their attitude. And monetary stimulus, it obviously reduces the cost of capital, which is important for higher growth, particularly technology stocks, because it feeds into the discount rate that gets applied in the valuation process. So all the stars are pretty much aligned, and yes, there will be unexpected events come along, of course, but the longer term trend would certainly appear to be to the upside. So that's a very positive finish to the week. Now, most people nod and accept that the US market is in a bubble. There's just so much commentary to that effect. And also, it's logical to conclude that when prices have been going up for a significant amount of time, it just feels natural to conclude that the US market is in a bubble. And some parts of it are, no question, but it just kind of feels like it should be. But if you actually look under the hood, and according to Bloomberg, when you look at the more aggressive sectors, particularly technology and a couple of other sectors, the price rises in the stocks are being almost totally driven by earnings growth. There isn't multiple expansion here. There is in some parts of the market and with some stocks within sectors. But as a general statement, the more aggressive growth sectors, the price rises of the stocks are all about earnings growth, which means it's sustainable. And we're not into a bubble territory. So you've got to be careful about what it is that you naturally accept because it just feels right. Because in this case, if you're focused on the parts of the market that are really my total domain, and that is the higher growth, higher probability, best of the best sectors of the market, then valuations really aren't an issue. So don't get conned by the media or these sort of natural throwaway lines that the US market might be in a bubble. And if the market keeps increasing in value at the index level, which is now likely given Powell's comments on Friday night, then that sentiment is only going to intensify. There's going to be more and more calls for the fact that the US market is in a bubble. Don't accept it as a natural, obvious conclusion. And I could give you many hundreds of examples where that's not the case, but let's choose Google. It's trading on 18 times FY26 earnings, which is what's being priced into the market at the moment. And for a stock like Google, with their growth, with their outlook, the way they're positioned, 18 times is absolutely fine. So there is no bubble issue with Google, just as one example. And there are many, many others that fit into that category. So it's just a matter of just simply picking wisely. Understand what your game plan is, select the best of the best in each of the sectors, and just get on with it. The other point that I want to make too is that the commercialization of AI is real. And as the momentum builds in AI, again, the natural conclusion is that it's just getting way ahead of itself. But when you really understand what is happening with AI, the comparisons to the tech wreck of 2000 are just simply ridiculous. This is real. Companies are making real profits from AI, real growth from AI. And if you listen to some of the well-informed commentators, the future just looks unbelievably rosy. And I don't think anyone really much has an idea of where this is going to end up in 5 or 10 years' time. It's a very exciting period, and I should be forming a significant part of most investors' portfolios. All right, now, of course, getting the wider advice, be that legal or financial or any other advice before you take action on anything in this video, is essential. Let's have a look at the market specifically. American stocks, the S&P was up 0.25% for the week, but the NASDAQ fell 0.6%, and that's because the NASDAQ had a much harder time of it earlier in the week. And basically the week was down almost every session before we got to Friday, which was a pretty spectacular reversal. But overall for the week, small caps did really well. The Russell 2000 was up 3.4%, so that's a distinct outperformance. So that little wobble that I spoke about last week, where the market breadth for just a couple of days disappeared, that appears to be very, very transient. And we're now back into a broad-based rally, and small caps are certainly benefiting. So we saw a huge reversal on Friday. We'll have a look at that in a minute. And I thought I'd just pick out one aspect of Powell's speech that quite surprised me, actually. And he said that inflation risks are to the downside. And I found that very surprising. But nevertheless, that is what he said. And of course, that makes it easier for the Fed to justify cutting interest rates. Now, the US dollar index fell on that news on Friday, down to 97.73. The fact that interest rates were almost certain to be cut in September. The 10-year yield also came off a little bit, back down to 4.26. And the VIX pretty much collapsed down to 14.2. So that's as low as it's been for quite some time. Let's go and look at some charts. We'll start with the NASDAQ. This is a daily chart, and you can see the week before we got to Friday, it was like a Coles ad. It was down, down, down. And then Friday, quite a significant turnaround. And if we put that up on a weekly chart, you can see it all looks pretty benign, really, when you look at it on a weekly basis. All we're doing is just continuing the trend that's been in place since we saw the lows following Liberation Day. Semiconductors did well. This is a weekly chart of semiconductors. They pretty much reflect what the NASDAQ composite was doing during the week. It was down until we got to Friday, and then quite a sharp reversal. And I'll just pop that on a daily. There you can see a little bit of selling pressure at the end, but overall, we've got a very strong uptrend. We might be just getting a little bit of consolidation. We've got tails top and bottom during the week, indicating that the market is pretty much in balance between buyers and sellers. So there's an emerging consensus that the current level, the market is comfortable. But of course, that can change quite dramatically with any sort of news announcement or event around some of the larger stocks like Nvidia or Broadcom. When we look at the relative comparison over the last month, I posed the question last week, was there a rotation starting because consumer staples and healthcare had good weeks? But if we look at what's happened in the last week, XLY, consumer discretionary, rebounded to the top. XLC, communication services. Energy comes in third, then healthcare, and then we've got staples. But whilst technology is towards the bottom of this last month's pecking order, it's certainly coming back fairly quickly. And on the Australian market, we certainly saw continued strength in energy. Small caps are certainly doing quite well at the moment. Banks rebounded quite strongly. Commonwealth Bank had been really messed up the week before, but other results around ANZ and Westpac supported the finance index. But right at the bottom of the tree was the healthcare sector, and that is heavily a result of the massive plunge in CSL. There is the S&P. So we had a lesser downside during the week in the S&P than the NASDAQ, and a pretty strong Friday as well. And to finish off, that's the Russell 2000 for small caps. That was a very emphatic day on Friday. Checking it on the currencies, US dollar index, sharp move down on Friday. So we're in a consolidation period at the moment that's been in play now since June, but the overall trend is quite clearly still down. And with the Fed now moving into the rate cutting cycle, the downward pressure should continue. The Australian dollar, on the other hand, had a good session on Friday, kicked up with the US dollar going down. But it's a bit problematic whether the Australian dollar will just be an inverse mirror image of the US dollar. I think there are other factors at play that will probably keep some downward pressure on the Australian dollar as well. All right, moving on now to Aussie stocks. So 64.23 was where our dollar finished. And I do note that the majority of retail traders are long, which, if you put your contrarian hat on, means there's a higher probability of the Australian dollar going down, because the majority of retail traders generally get it wrong at the extremes. It's just the way that it works. The ASX index was up 0.3% for the week, but I think it's fair to say there's going to be a pretty robust start on Monday morning, given what happened in the States on Friday. So we've breached 9,000 points, but there was a pretty big roller coaster for individual stocks, and we saw stocks like CSL, James Hardie, GYG, ING, Accent, and quite a few others got absolutely smoked. And we're talking 20% plus price plunges because the market just didn't like the results or other aspects of their report. So it was a very stock-specific market last week as far as earnings go. And the overriding theme is, if you disappoint the market on what they're expecting, then your share price is going to get absolutely toasted. So that is probably the key theme out of earnings week last week. Now, it raises a question for the stocks that are going up. Are the prices going up because we're getting multiple expansion? The PEs are getting bigger. Or are the PEs staying the same? It's just the price is tracking the earnings growth. And it's very stock specific. I don't think you can make any particular conclusion about the Australian market. Extremely stock specific. So let's go in and just have a quick look at the Aussie market because it's pretty impressive. I can't buy into it because we've got a couple of specific stocks that are driving the index quite heavily. This is on a daily chart, and it's just not reflective of the market in general. But there you go. We managed to get above 9,000 points, got to a high of 9,019 on Thursday. And I would expect that this will probably continue on Monday. Just add the comment too that smaller miners are certainly getting a lot of love. That's what I talked about last week. And there is some real momentum building. Some of them are really getting ahead of themselves. So there's quite a bit of danger there. That market's getting a bit speculative, a bit frothy. But they're certainly getting a lot more attention now than they have been for the last several years. Now, turning to precious metals, gold was up $35 to $33.71. So it was a good session on Friday. Quite a bit of that was about the US dollar falling. Translate that to Aussie dollars, 52.10 is where we sit. But the bigger move was in silver in percentage terms, up almost to $39. And silver stocks in America certainly responded very strongly. On Friday night, I saw gains of between 5 and 10% for individual silver stocks. Now, part of this is the uncertainty being created around the independence of federal agencies, not the least being the Fed, but other federal agencies as well, where people are being prolifically sacked because President Trump doesn't like the data. Whether that's valid or not remains to be seen, but certainly questioning the independence of federal agencies is not a good thing at all for the market. And whilst the equities market seems to be ignoring it, the precious metals market is certainly taking note. And I think that's feeding into some of the buoyancy in the metals prices. And of course, the US dollar sliding on Friday night helped as well. Negative rates, if that's where we're headed, is always a boost for the gold price as well. And we are seeing a divergence between gold and silver. Silver is outperforming gold now on a percentage basis. And it's still got a lot of catch up to do. So on a historical basis, silver can still catch up quite significantly, something of the order of 50% relative to the gold price. Now, if we look at gold stocks, GDXJ, which is a global index for all but the mega cap gold stocks, it's a classic breakout, then a retest of the breakout, and then it's off again, as we'll see in the chart. So we'll start with silver on a weekly basis. So it was quite a range last week, and in fact, it's been quite a decent range over the last 4 or 5 weeks, but we finished on the highs. And if we put this on a daily chart, we got a reversal on Wednesday, followed through nicely on Thursday, and then sustained that momentum on Friday. If we look at the US dollar on a weekly chart, you can see, this is on a daily chart, you can see what we're building towards. It's quite a distinct inclined triangle, so you would expect that eventually we're going to break out above this 34.42 level. We've had 4 cracks at it already, or the initial peak set, and then 3 more attempts. You would think every time we go up here and attempt to break through this 34.40, 34.50 market, it's weakening the resistance. It's clearing out the selling overhang. So that's looking pretty impressive. If we put this on a weekly chart, you can see it's even more impressive. We've got a high-level consolidation that started in April, and it would appear to be just a matter of time before the uptrend continues. And in Australian dollars, once we throw the currency conversion in, it's really just one big consolidation there as well. And the final thing, we got a very positive response from Bitcoin on Friday night as well, and closed at basically 117,000. All right, so that's the big picture on a weekly chart. So this goes all the way back to 2014 for GDXJ. We formed a peak in 2020. We've then been significantly down. So index had fallen from around 65, got down to 30, just under 30. So that index had lost more than half its value. But now we've surged back again, and now we've got this breakout, retest of the breakout, and now we're off again quite strongly. So that's the very big picture view. We're now well above all of the short and long-term moving averages. So that would appear to be a very real renewal of the uptrend. So certainly the last 3 weeks have been extremely positive for global gold stocks. But let's come in a little bit further. So it's the weekly chart. Let's look at the daily chart. You can see Thursday and Friday, very strong breakout there. So that's what's happening globally. If we look at GDX, which is listed on the Australian index, and this also encompasses global gold stocks, but you can see we've been moving quite well here, and this will get certainly some added boost on Monday. So very, very strong trends there in the gold sector. Turning to other commodities, copper was unchanged at 445, not much happening there. The near-term sentiment is weak, but the long-term remains pretty bullish. And it's just technically in balance at the moment. That's where the market is comfortable being, around the 450 mark. And it only really was the disruption from tariffs, the threat of 200% tariffs, that moved the market. West Texas Intermediate crude, 63.77. There's just generally a bearish tone at the moment, which is really surprising in the oil market because energy stocks are certainly looking more positive than that. We've got some rising global inventories. We've got weak demand, question marks around China, question marks around what OPEC might do. And so that's just keeping WTI crude anchored where it is. When we look at lithium, it's a very confusing picture, and it's very hard for me to feel confident about what's happening in this market. We've got confusing signals on the demand side. So lithium carbonate prices have been extremely volatile. Of late, we've got frequent limit up or limit down sessions. We've had a few more limit up sessions, but it's just all very speculative and immature market. Immature meaning that it's not a market that really has time on its side in terms of proven stability. So we've got lithium carbonate prices jumping all over the place in a market which you can't really say the price discovery mechanism is reliable, and yet stocks are being priced off that. So stocks are being priced off a signal that is quite unreliable. So that's why I just can't get comfortable with the lithium market as it stands. And the other factor is that the actual buyers, I'm not talking about the speculators, but I'm talking about the actual industrial buyers, apparently are just not willing to pay the prices. They're not playing ball, and they've got plenty of inventory that they can draw on if they need to. So whilst prices might be up, lithium carbonate prices might be up, doesn't automatically connect that that is the price that's being paid. This is largely a game being played by speculators, from what I understand. And battery makers have got certainly some capacity to draw down on inventories. So it's not a particularly encouraging demand side. And when we look at the supply side, that's not a whole lot better either, because we had so much capacity built out in 2021, 22, 23 that has been partially switched off, so that any price rises, we can just see that production switch back on again. So there's a lot more potential production that could be switched on quickly. So that's why I think getting excited about price rises and naturally assuming that those price rises will just continue like they did in 2019 and 2020, I don't think is the correct conclusion. There are just so many unpredictable aspects, and it's all being muddied by the amount of speculation that's going on. So would I bet on that mixture? No, is my conclusion, because there's just too many things that may go wrong. To me, the probabilities are not high enough to be putting any sort of significant capital into the lithium market at all. But there's a lot of people getting excited about it, so I guess anything can happen. There's the spot copper chart. So we've just been stable now since the tariff situation on copper got clarified. Wrapping things up, clarity is the investor's most prized asset. It really is. It surprises me how few investors really take the time to sit down and get clear about what they need to do. It's a very, very simple process. I can only conclude that it's because most people think that they don't have the information, that it's challenging to do, and there's so many uncertainties. But it's actually a very simple process. And the majority of things that happen in the market, we can actually control, or we can control what we need to. Certainly far more than things that are outside our control. So you just focus on that. So getting clear about what you want and how you plan to go about getting it with a degree of reliability is the essence of successful investing. That's it right there. And it's not hard to do. It's quite simple and straightforward. Sticking to it is another question. Most people struggle big time to stick to it, and that's why you need to remain in some sort of environment that continually refreshes your perspective on what's happening, that you don't get drawn in by the media. Just focus on owning just the best of the best. Forget traditional diversification. That's complete rubbish. Just understand what sectors and megatrends you want exposure to. Identify the best of the best in each of those sectors and just do that. It's not hard. Enter well, manage well, avoid getting spooked when the market does very short-term things for no apparent reason. If you own quality assets, why would you need to be spooked by what the market is doing? It just doesn't make sense. And just loosely keep your finger on the pulse of the market. And for most people, that means tapping into resources that they trust. So if you just do that, the probability of achieving a very good outcome are significantly higher. Portfolio analysts last week, we did a deeper dive on artificial intelligence, breaking it down into the sectors and industry groups and how to structure one's portfolio. It was a very beneficial sector for those looking to get more clarity around AI. That's it for this week. There's more information on the website, and there's my email address, and I'll be back with you as always next Sunday. Cheers.